Hello everyone and welcome. The biggest names in the stock market have become the biggest drivers of portfolio returns and risks. Over the last decade, a small group of megatech companies has dominated performance, creating a market that is heavily concentrated at the top. A market growing more concentrated. A small group of megacap companies, often called the Magnificent Seven, now represents roughly 1/3 of the S&P 500's total market value. When you buy a broad S&P 500 index fund, a large share of your investment is effectively allocated to just a handful of these firms, which reduces diversification compared with more evenly distributed index. If some of these large companies underperform, their size means they can materially impact the index's overall return. The under-the-radar shift. While attention has focused on mega-caps, small-cap stocks have lagged behind for much of the past decade. Over very long periods, however, small caps have historically delivered higher average returns than large caps, although with higher volatility, and no guarantee this pattern will persist. Recently, the valuation gap between U.S. small caps and large caps has widened, with small caps trading at one of their largest discounts in over 20 years, on measures such as price to earnings and price to book. At the same time, the phase of rapid interest rate increases has paused, which may be supportive for smaller, more rate-sensitive companies, though future central bank policy and economic conditions remain uncertain. The Russell 2000 and how to invest. The Russell 2000 index tracks approximately 2,000 smaller U.S. companies and is commonly used benchmark for U.S. small-cap equities. Analyst forecasts at times indicate higher expected earnings growth for small-cap companies compared with large caps, but these projections are forward-looking and subject to change. It is generally easier, from the mathematical standpoint, for a smaller business to grow at a higher percentage rate than a very large one, although individual outcomes vary. A straightforward way to gain exposure to the Russell 2000 is through exchange-traded funds, ETFs. Two widely used options are IWM and VTWO, both of which seek to track the Russell 2000 index. IWM, the iShares Russell 2000 ETF, has a high average daily trading volume and is frequently used by active traders and options market participants. Its expense ratio is about 0.19%. VTWO, the Vanguard Russell 2000 ETF, offers similar index exposure with a lower expense ratio around 0.10%, which can be attractive for cost-conscious long-term investors. For investors who prioritize liquidity and very active trading, IWM is often preferred. For investors focused on long-term buy-and-hold exposure with lower ongoing fees, VTWO is often considered a suitable choice. In conclusion, the increasing weight of few mega-cap companies in major indices means broad market performance is heavily influenced by a small group of stocks. At the same time, U.S. small caps currently trade at a historically wide valuation discount to large caps, which some investors view as a potential opportunity, though it comes with higher risk and uncertainty. Using low-cost ETFs such as IWM or VTWO allows investors to add diversified small-cap exposure to a portfolio in a simple, transparent way. We hope you found this breakdown of the Russell 2000 helpful. Like and subscribe. Stay active, powerful, and diversified. See you in the next one.